the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But first, a quick recap of some key movements to watch. While Singapore shares were lower today as traders continue to mount the state of the global economy. So if we look at the Straits Times Index, it was down 0.2% at 3,874 points at about 1:54 p.m. Singapore time, with a value turnover of some 673 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI closed flat at 3,882 points. In terms of value turnover, we are looking at 1.17 billion Sing dollars. Gainers outnumbered losers, though, 273 versus 205. Top advances for today, we've got for you Semco Industries, Bukit Sembawang, and SIA Engineering. Top decliners, we've got GMHUSD, DBS, and SGX. Now, in terms of companies to watch, we have CapitaLand Investment after the global real asset manager today announced the launch of its first onshore master fund in China, also known as the CLI RMB Master Fund. Now, elsewhere from Nvidia CEO Jensen Huang praising US President Donald Trump's move to scrap some AI export curbs, to Singapore Central Bank Chief's comments on US dollar-based assets. We've got more corporate and international headlines in focus. And joining me today on the line is Khoon Goh, Head of Asia Research at ANZ. Khoon, welcome back.
Hi, glad to be back.
Glad to chat with you today. And Khoon, as usual, let's start with the Singapore stock market. How did the STI fare today, and any surprises when it comes down to the biggest movers and, of course, the sectors that they lie in?
Well, as you mentioned, the overall Straits Times Index traded flat, which is not a bad result given that there's concerns about rising U.S. bond yields and also the spike up in geopolitical concerns over the report about potential attacks by Israel on Iranian nuclear facilities. All said and done, I think it's a reasonable performance given that we seem to see the U.S. futures market under some pressure.
I see. And Khoon, zooming in on the companies to watch, we've got here CapitaLand Investment, because the global real asset manager today announced the launch of its first onshore master fund in China, also known as the CLI RMB Master Fund. I know you don't comment on individual companies, but generally speaking, what are the benefits of launching such onshore funds in China? And perhaps the second part of the question, will we see more property developers following suit given the current global economic climate?
Yeah, this is a very interesting move because it probably signals that there's increasing confidence about the Chinese economy and particularly the property sector over there. Now, we all know that the Chinese economy, particularly the property sector, has really been struggling over the last 5 years. And the fact that this company feels that the time is right to start to get or increase their exposure into property in China by raising these funds and starting to undertake investments, probably at the bottom of the cycle, probably signals that they think things are starting to pick up. And, you know, with both US and China now entering a ceasefire and hopefully some kind of deal can be reached, maybe then we will start to see signs of a more meaningful pickup in the Chinese economy going forward. And if that does happen, then I think the timing of that could be right, and we could well see other companies starting to make such moves.
I see. Well, across the region, Khoon, Beijing today condemned new U.S. warnings on the use of AI chips made in China, vowing that it would take steps against what it calls bullying efforts to restrict access to high-tech semiconductors and supply chains. I believe we're looking specifically at tech giants Huawei's Ascend chips. What do you make of the latest comments, given how U.S. President Donald Trump's administration last week rescinded some export controls on advanced computing semiconductors?
Well, this is really the U.S. trying to ensure that U.S. technology remains the dominant one, and they are really trying to discourage other countries from purchasing chips made in China. Now, it's quite interesting that on the one hand, they are trying to wind back some restrictions, but on the other hand, they're imposing new ones. I think net-net, the U.S. is just obviously trying to do what they think is in their best interest to try and make sure that U.S. technology and their technological advantage is maintained over China. So by imposing some restrictions, they're hoping that they can, buy them more time and, push China's ascendancy in chip technology further back.
Now, if you're just tuning in, we're in conversation with Khoon Goh, Head of Asia Research at ANZ. Well, staying on the topic of semiconductors and the rollback of export controls, Khoon, Nvidia CEO Jensen Huang, he said at the Computex AI exhibition in Taipei today that U.S. export controls on AI chips to China were a failure. They have cost American companies billions of US dollars in lost sales. Now, at the same time, he also praised Trump's approach to AI and said that by reversing the prior restrictions, Trump demonstrated that he understands U.S. companies are not the only providers of such technologies. Any thoughts on Huang's comments, given, earlier we talked about how the latest move by the Trump administration looks like a rollback, but at the same time, not quite the case if we look at the new guidelines as well?
Yeah, so from the point of view of Nvidia, the restrictions obviously hampers their ability to increase their sales. And there is also recognition that the U.S. companies are not the only ones that can make high-end chips, as the advancement that China has achieved so far attests to. So if those restrictions were to continue, the danger was that other countries that were restricted in accessing U.S. chips would simply then source it from China or other competing countries. So by easing back the Biden restrictions, this ensures that the U.S. companies can, continue to dominate. So this is one area where I guess commercially it makes sense. But I think from the other aspect, that's why the Trump administration is also, by the same token, looking to restrict the ability of other countries to access Chinese high-end chips. So again, it is all part of a larger game. Of the U.S. trying to ensure that they remain dominant.
But, given Nvidia Jensen Huang's comments, does he seem to be trying to be on the good side of the new administration?
To be fair, it's not just
it's not just him.
I think a lot of U.S. companies are trying very hard to make sure that they are on the right side of the Trump administration. And I think that's the way it's going to be for a while.
Yeah. Stay in the U.S., Khoon, Singapore Central Bank Chief Chua Tian Tian, he spoke at the Qatar Economic Forum yesterday, where he noted that U.S. dollar-based assets have what he calls enduring advantages and remain virtually irreplaceable in the global financial system. This, of course, despite the U.S. losing its AAA credit rating. What's your take on the matter?
Well, I totally agree with the MAS Managing Director. The reality is that, yes, Moody's has downgraded the U.S. credit rating, but they were the last of the three major rating agencies to do so. I mean, the U.S. has lost their AAA rating as back as 2011. That was when S&P first downgraded the U.S. Now, the question then is, having lost its AAA rated status, will investors suddenly look to dump all their holdings of their U.S. treasuries? They are not, because what is the alternative? The U.S. is the largest, most liquid fixed income market in the world. The second largest fixed income market is China, and the third is Japan, but the size of it is still vastly significantly different. So if you were to sell off the U.S. treasuries, you're not going to want to allocate completely into the Chinese market or even the Japanese bond market, because the other problem of the Japanese bond market, of course, is that the Bank of Japan actually owns a huge chunk of the JGB market. So the actual free float, or how much is actually available for foreign investors to invest in, is a lot smaller. And for the Chinese market, you still have restrictions. It's not AAA rated as well. So really the lack of alternative, or what we call TINA, there is no alternative, means that for a lot of investors, they are basically stuck with the U.S. treasuries, and you'll just have to weather the fact that it's a AA plus rating rather than a AAA.
Okay, and finally, before we let you go, Khoon, let's talk more about the U.S. in particular, that this tax bill that could add about $3 to $5 trillion US to the U.S. federal government's ballooning $36.2 trillion USD debt load. It is expected to be voted on later in the week in Congress. Your thoughts on what the tax bill could mean for both the U.S. economy and also U.S. equities?
Well, this is really a double-edged sword because if the tax bills were to go ahead, then it makes permanent Trump's first-term tax cuts and also introduces, further tax cuts that will, provide more disposable income to households and that can help to boost spending, which is the positive part of the impact on the economy. But the downside is that the U.S. government is already running a large fiscal deficit to begin with, roughly around 6% of GDP. And the tariffs are definitely not going to raise enough revenue to fund any part of those tax cuts. So you're going to potentially end up with even larger fiscal deficits. And this is partly why Moody's has downgraded the U.S. And that's why you're starting to see the bond market starting to worry about the size and the permanence of large fiscal deficits. So that's why we have to watch what the U.S. bond yield is doing. The 10-year bond yield, for example, is inching towards 4.6%. The 30-year bond yield has already gone past 5%. So those are very key levels. If those yields continue to go up, that's going to make costs of debt servicing more expensive for businesses, for households, mortgages, and of course, what U.S. yields, where U.S. yields go, that also has flow-on effects to yields globally, including in Singapore as well. So it's really critical to watch how the markets react to this.
I see. Lots to watch indeed. Thanks so much for the insights, Khoon. That was Khoon Goh, Head of Asia Research at ANZ. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.